Gross inflows of £38 billion. Tell us the overall picture, if you like, in terms of those inflows. What's been driving that?
Yeah, I think it's been a pretty encouraging half year. That's up from the second half of last year, which was the first sort of 6 months following the merger. The very encouraging thing is that about 80% of those flows are in what we would call our non-sort of blockbuster or the assets that have driven the success of both companies in the past. So it's a very well diversified inflow picture we have. But as Manna said, market conditions are tough out there for the industry, and we certainly feel we're in one of the best positions with one of the strongest balance sheets in the world to weather what's going to be a tough period ahead.
Martin, a very good morning to you. Look, when you put this company together, Standard Life in Aberdeen, I remember we had the conversation, you were quick to speak to us. It was the $1 trillion club you wanted to get to. What is the reality, Martin? Is that off the table? Is your ambition no longer to hit $1 trillion in terms of assets under management? What is the ambition now? What's the realistic ambition for Martin Gilbert and the team at Standard Life Aberdeen?
Well, as I never thought we'd ever get to £1 billion, to be at sort of 600 and something billion is way beyond our expectations. So yeah, no, we'd clearly like to be bigger. And I think the key point I was trying to make was scale matters in this business now. The industry is sort of moving towards the big and the boutique, and we, both Standard Life and the Legacy Aberdeen, made a decision that we wanted to get ahead of the industry trend here, and we combined, I think, before everyone else, and we're one of the first groups to see costs down. I think I look at all our competitors, costs are up. Last year, our costs are down. So we're addressing the industry issues, I think, before other companies are. And obviously, we'd like to have $1 trillion under management.
You say scale matters. Talent also matters, of course, Martin. Aviva investors have been building up, and even in your backyard, setting up an office in Edinburgh, I understand, to house people that they've been taking from your business. Do you feel threatened by the competition at this time?
No, quite the reverse. I mean, look, we want Edinburgh to be a financial centre, and to use a term, fake news. That was a great example of fake news. I mean, these were people that had left our business as a result of the merger. And we're absolutely delighted they've got jobs in Edinburgh, because it keeps Edinburgh as a financial centre. But it was certainly fake news to put out an announcement that these people had left us to join Aviva. But you know, needs must, I suppose, in the industry. So, but as I say, look, we're delighted they've got jobs in Edinburgh, and delighted that Edinburgh really continues as a big financial centre, and people are setting up there.
Martin, I know that you've had meetings with Donald Trump, but now, you know, when you're channeling it into the media message, it's a shocker. Listen, the world is moving towards fees. We've seen Fidelity do it. Would you be introducing fees? Would you be interested in moving, even if it's part fees? Is that the way that you should go at Standard Life Aberdeen?
Well, I think you've really hit upon one of the big issues for the industry, which is declining fees. Clearly, we'd rather not go to 0%. And obviously, the funds that Fidelity have at 0%, they're hoping to make money on stock lending. Now, you could argue that stock lending fees belong to the client, so it's not a truly 0%. But what it does show, Manus, you're absolutely right, is this industry is under enormous fee pressure at the moment, which is why which is why I think we'll see further consolidation in the industry to address declining margins.
And in terms of the, I wonder if you could just clarify what we're seeing on the inflows and outflows here then, Martin. We've got gross inflows of £38 billion, but first half net outflows from continuing operations of £16.6 billion. Is that correct? And is that something you can talk to?
Yeah, no, that's the numbers, and that's an improvement on the second half of last year. So we're seeing a continuing improvement in flows. And as I said earlier, the encouraging thing is that the gross flows coming in are going into 80% of them are going into what we would have termed the non-blockbuster products, for want of a better word. But we're seeing an improving situation. But what we're seeing, again, in the industry is this move from active to passive. So it's not a great time to be an active fund manager in the industry. As Manus just said, fees are being compressed by the passive fund managers. So the industry is in a tough place at the moment.
Martin, that's one side of your life. It would be remiss if we didn't try and squeeze a little one in from you on Sky. You're an advisor on that board. Your thoughts on the proposition on the table, on the deal?
Yeah, no, I think it's, I think the independent committee of the board representing the 61% of shareholders that are not in the Fox camp have done a great job. We're at about a 90%, 92% premium. And we'll just have to wait and see what happens now. Now that the Disney-Fox deal has gone through or been voted through by shareholders, any move by Fox is really in Disney's hands now.